45 million Americans are completely invisible to banks, landlords, and lenders. Not because they're broke, not because they've done anything wrong, simply because they have no credit history, no file, no score, nothing. No credit history means you pay more for car insurance. You get rejected for apartments. You pay higher interest rates on loans, sometimes double what someone with good credit pays for the exact same thing. The fix is a single credit card, used correctly, for 12 months. That's it. One card, 12 months. Your score goes from 0 to above 700 and doors that were closed start opening. But here's the problem. Most people pick the wrong first card and either get rejected or pay fees they didn't need to pay. Or worse, they end up in debt before they've even started. This video is the math behind picking the right first card. No sales pitch, no affiliate fluff, just the numbers. Your credit score is a number between 300 and 850. 35% is payment history. Did you pay on time? This is the biggest single factor. Miss one payment and you feel it for months. 30% is credit utilization. That's how much of your available credit you're using. If your limit is $500 and your balance is $400, your utilization is 80%. Keep it under 30%, ideally under 10%. 15% is length of credit history. How long have your accounts been open? This is why you want to open your first card as soon as possible and never close it. The clock starts the day you open it. 10% is credit mix. Do you have different types of credit cards and loans? Irrelevant for now. 10% is new inquiries. Every time you apply for a card, the issuer does a hard pull, a formal check of your credit. This temporarily drops your score 5 to 10 points. Within a few months of on-time payments, you'll more than recover it. But apply for 5 cards at once, and you've got a problem. So the math is simple: one card, pay on time. Every month, keep your balance low. Never close it. That's 80% of your score right there. There are exactly 3 types of first credit cards. Not 10, not 50. 3. Let's go through each one. Type 1. The secured card. A secured card requires you to pay a refundable cash deposit up front, usually between $200 and $500. That deposit becomes your credit limit. So you put down $200, you get a $200 credit limit. The bank's risk is 0. They have your money. That's why they'll approve almost anyone. No credit history required, no score required. Bad history? Still, probably approved. The best secured card in 2026 is the Discover It Secured. It requires a $200 minimum deposit, earns 2% cash back at gas stations and restaurants, 1% on everything else, has 0 annual fee, and graduates you to an unsecured card within 6 to 18 months of responsible use. That last part matters. A graduation path means Discover wants a long-term relationship with you. They're not just taking your deposit and forgetting you. Type 2. The student card. Student cards are unsecured, no deposit required. They're aimed at college students who are at least 18, have limited income, and no credit history. You do need to show some income. Even part-time work qualifies. The best student card in 2026 is the Discover It Student Chrome. No credit history required to apply, 0 annual fee, so you can keep it open long after graduation. Reports to all 3 major credit bureaus, and it waives your first late fee. A welcome spot of forgiveness for those just getting started. There's also the Capital One Quicksilver student. 1.5% flat cash back on everything, no annual fee, and a $100 bonus after spending $300 in the first 3 months. Simpler rewards, easier to manage. Type 3. Unsecured starter cards. These are regular credit cards with lenient approval requirements for people with thin or no credit files, no deposit. But approval is stricter than secured cards. The best option here in 2026 is the Tilt Essentials card, the direct successor to the Pedal 2 after Empower acquired Pedal in 2025. It evaluates your bank account health instead of your credit score. No deposit required. Up to 3% cash back on certain categories, 1% on everything else. Reports to all 3 bureaus, no credit check, no deposit. And it still builds your score. That's genuinely unusual. Here's the decision tree. Answer these 3 questions and you'll know exactly which card to get. Question 1. Are you currently enrolled in college? If yes, get the Discover It Student Chrome. Full stop. No deposit. No annual fee. You'll earn rewards while building credit. Done. If no, move to question 2. Question 2. Do you have any credit history at all, even as an authorized user on a parent's card? Being added as an authorized user on a family member's card can help build credit. If they have a long history of on-time payments and low utilization, you can benefit from that history being added to your file. If you have even a few months of history, try the Tilt Essentials Unsecured card. No deposit, no credit check, uses your bank account data to approve you. If you have 0 history, move to question 3. Question 3. Do you have $200 available to lock up as a deposit? If yes, get the Discover It Secured. Your $200 deposit comes back when you graduate to Unsecured in 6 to 18 months. You earn rewards in the meantime. If no, get the Open Sky Secured Visa. No credit check, no checking account required for approval. Approval is guaranteed if you meet the minimum deposit of $200. It's the most accessible card on this list. No frills, but it builds your score. One more rule that applies to everyone. Start with one card and master it for at least 6 to 12 months before considering a second. Opening multiple cards at once results in several hard inquiries, lowers your average account age, and increases the risk of overspending. You've picked your card. Now here's the exact operating system for using it correctly. Rule 1. Pay the full balance every month, not the minimum. The minimum payment is a trap. Here's the math. You spend $300 on your card. The minimum payment is around $25. Sounds fine, but at a 24% APR, which is standard for beginner cards. Paying only the minimum means you'll pay that $300 balance off in 16 months and spend an extra $60 in interest. For $300 of spending, that's a 20% tax on everything you bought. Pay the full balance. Always. No exceptions. Rule 2. Keep your utilization under 10%. Your credit limit is $500. That means your balance when the statement closes should be under $50, not $150, not $200, under $50. Here's the trick most people miss. Your utilization is calculated at statement close, not at payment due date. So if you spend $400 in a month and pay it off before the due date, but after the statement closes, the bureaus already saw $400 on a $500 limit. That's 80% utilization. Your score drops. Pay your balance down before the statement closes, usually a week before your due date. This one habit alone separates people who build credit fast from people who wonder why their score isn't moving. Rule 3. Set up Autopay immediately. One missed payment drops your score by up to 100 points and stays on your report for 7 years. Set Autopay for the minimum payment as a safety net, then manually pay the full balance each month. Autopay is your insurance. Manual payment is your strategy. Rule 4. Never close your first card. The card's date of opening becomes part of your credit history length, which makes up about 15% of your FICO score. That is why the cheapest, simplest, longest-running first card is usually the best long-term choice. Even when you upgrade to better cards in 12 months, keep your first card open. Use it once every few months for a small purchase. The age of that account is compounding silently in your favor every single month. 4 mistakes. Each one sets beginners back by months. Mistake 1. Applying for multiple cards at once. Every application is a hard inquiry. 5 applications in 1 month signals financial desperation to the bureaus. Your score drops, your approval odds drop, and you've created a mess that takes 6 months to clean up. Pick one card, apply once. Mistake 2. Maxing out the card. Common beginner mistakes include using the card like extra money and carrying balances they cannot pay off. These habits can quickly lead to debt fees and damaged credit, which may take years to repair. Your credit card is not extra money. It is a score-building tool. Use it for one fixed recurring expense, a streaming subscription, or your phone bill, and pay it off automatically. That's it. Mistake 3. Paying the minimum and thinking you're fine. You are not fine. See the math above. Full balance every month. Mistake 4. Not checking which bureaus the card reports to. The card must report to Experian, TransUnion, and Equifax. Skipping a bureau slows credit building. Before you apply, confirm the card reports to all three. Every card on this list does, but not every card on the internet does. Here's the summary in plain numbers. College student with no credit, Discover It Student Chrome, 0 deposit, 0 annual fee rewards from day one. No credit, not in college, have $200. Discover It Secured, best graduation path in the industry. Your deposit comes back. No credit, no deposit available. Open Sky Secured Visa. No credit check, guaranteed approval, just needs the deposit. Some bank account history, want no deposit. And no credit check, Tilt Essentials. The most underrated card on this list. Whichever card you pick, the math is the same. Pay in full. Keep utilization under 10%. Set Autopay. Never close it. Do those 4 things for 12 months and you will have a credit score above 700. That's not a promise. That's arithmetic.